So good morning again. My name is Roy Thompson. I head up MHA Carpenter Box Financial Advisors, and this is the third series now of At the Coalface, and I'm with James Giblin again. James, for those who don't know, is an investment manager at LGT Vestra. James sat with me on the first episode, so welcome back, James.
Morning, Roy. Happy New Year.
Yeah, Happy New Year to you. So I guess we did a couple of weeks ago, we did a short video, and that was just before the Senate vote in the US. So the result of that went with the Democrats, of course, which I guess in my head was a little bit of a surprise. But what does that mean from an investment perspective, James?
So the two seats in Georgia going to the Democrats means that the Senate's now split 50-50. Vice President Kamala Harris will now get the deciding vote. So the Democrats now have control of the Senate with the slimmest majority possible. What that means essentially is you have the progressives on the Democrat side pushing for more extreme policies, and you have the moderates very much trying to control spending. So Biden's got quite a difficult job there to maintain that. The market initially saw tech pull back, just worries about higher taxes and more regulation and possibly breaking up of these big companies, and cyclical stocks. So these are kind of your energy stocks, your miners, your financials. These ones gained just to more promises of stimulus.
Yeah.
So what will happen from here? The first thing on Biden's agenda will be the proposed $1.9 trillion spending plan.
Yeah.
And the main components of this are firstly direct payments, so bumping up the previous $600 payment to add an extra $1,400, bringing it up to $2,000. So that's the first thing that they're likely to do. Aid to states as well. So it's $350 billion going to states, and they're the main components. There's a few other bits on there as well. Child tax credit, extension to unemployment benefits, and just other COVID-related spending.
Okay. So additional fiscal stimulus, which I guess has been, markets have been generally positive since the start of the new year. So that sort of continues that trend. What impact does this continued fiscal stimulus have? I mean, I guess there's been some conversation about inflation. So where do we sit on inflation and the news about inflation?
Yeah, definitely. So that's one of the it's been a theme for us for some time, just focusing on this reflation trend. Obviously, it's been below targets for some time. The Feds tend to target 2%, and it's been way below that for a few years. COVID's obviously depressed that as well. But what we're seeing as we're looking forward is a lot more of the likelihoods of inflation surprises, mainly in the US, but we also see it elsewhere. And there's three main reasons for this. First one we've already touched on, so it's a lot of fiscal stimulus. It's unprecedented seeing both monetary and fiscal stimulus at the same time. So central banks printing money along with government spending it, whether that be direct payments, stimulus going out to states, or a lot of it could be infrastructure spending, particularly green infrastructure spending. It's very much a hot topic at the moment. It could be a good way that governments spend and stimulate the economy. Another factor that we believe could increase inflation, rising production costs. And there's kind of two factors for this. It's one where you're likely seeing day to day in the services industry. Because of COVID, there's extra costs, whether that be restaurants, they can fit a lot less people in with social distancing.
Yeah.
So they have to increase their costs. You go to the dentist and you pay an extra surcharge because of the equipment that they're now using. So that's probably the smaller factor, but it's still a factor that will increase production costs.
Yeah.
Second one, deglobalization of supply chains. So the US-China trade spat, that's not going to go away with Biden. There's bipartisan support for that. That will continue. It may be more predictable than Trump, which isn't difficult. But that will likely continue. And what a lot of manufacturers are doing now is, instead of going out and looking for the cheapest place to produce something, they're focusing a lot more on reliability. So instead of going out and finding the cheapest place, they find a cheap place that is reliable. So whether they move to different parts of Asia, Malaysia, Vietnam, these are the places that could benefit from this. But these supply chains may become more expensive, and they may actually look to bring back some of this locally, but that will increase costs. The final point, which is probably possibly the biggest factor here, is around policy. So central banks are now happy, particularly the Fed, to let inflation run a bit higher. Instead, in the past, they've been targeting 2% inflation as just a flat target. They've changed their wording now to target average inflation, implying that because inflation's been below average, below that 2% target, they're happy to let it run a bit higher.
And have they given a time frame for that average? So we can
No,
use it
so that,
over 20 years or over 6 months, it can vary greatly.
yeah, it can vary greatly. They haven't been massively specific on that. So,
So vague, which gives them a bit of leeway, I guess.
Exactly. And what's important to remember as well is that it's in government's interest for inflation to be high. They've now added this extra debt, this extra burden to their finances. And the higher inflation is, the lower the cost of that real debt. It's something that we've seen before. Following the Second World War, governments were quite happy to let inflation run high and inflate that debt away. But it's in their interest for inflation to run a bit higher. So these three factors are why we think inflation could surprise the upside. Maybe not in the short term, where demand's a bit suppressed, but over the medium to long term, we believe that there could be a bit of surprise there.
Okay, and what you're inferring there is that if inflation surprised to the upside, so it was above sort of long-term or medium-term trends, what you may still see is kind of a decoupling of that inflation from interest rates. So interest rates would still remain low, which allows that debt that's in place to effectively over time inflate away and the cost of it to diminish in real terms.
Yes, exactly.
Yeah. But okay, so I guess if we were to summarize that, we've got a situation where Biden's got a good amount of control in the US. He may well push for further fiscal stimulus. You referenced the deal he's put on the table or announced he's going to be putting on the table. And some of this, along with other factors such as production costs and bringing production, shortening those supply chains, I guess could mean inflation over the longer term. I guess too early to predict what that means for consumers.
Yes, definitely. I guess if you come back to inflation, you also want your wages to inflate along with it. Whether that will happen, we'll have to see in the future. It comes down to productivity, but definitely one to watch there.
Yeah. Okay. James, that's been fantastic as we've done so far, short and sweet, and we'll have a further update in a couple of weeks when I'm sure there will be some further news that will have affected what's happening in investment markets.
Thanks, Ray.
Thanks very much, James.